Press the bell icon on the YouTube app and never miss another update.
Friends, we are back again with another video on your channel Profit in Equities. Now, if you think the content that we produce is beneficial to you in any way, please go and give it a thumbs up. Also, do subscribe to our channel and share it so that we reach more people going forward. Now, today we have come to you with a list of 8 potential multi-bagger stocks which Ambit Capital calls as India's emerging global champions. Now, this is a hand-picked list, and all of these stocks have done very well for the last couple of years and have the potential to carry on their good run going into the year 2018. So please watch this video to know more. Now, the first company on the list is Rain Industries Limited, which is like a super multi-bagger for the last 1 year. Now, this is a global supplier of carbon products like calcined petroleum coke and coal tar pitch. Rain Industries Limited is also in a favorable position compared to its peers, says Ambit. Now, this company is basically India based and is engaged in the business of manufacture and sale of carbon products, chemicals and cement. Now, if you were to look at the 1 year chart, it's a beautifully uptrending chart, and even we had a position here at 50 but sold out at 100. Since then, this has gone on to a price of more than 370. Now, the current market price is 371.20. And if you look at it, the company is a mid-cap one with a market cap of 12,485.15 crores. The EPS is 16.1750, which means that the company is available at a price to earnings ratio of 22.6554. The industry PE is 44.96, which means that the company is cheaper compared to the industry standard. The book value is 95.3139, which means that the company is available at a price to book ratio of 3.8945. The promoter holding here is 41.10, which is on the lower side. Now, this company will benefit from its long-standing relations with customers and suppliers, and also the proximity to raw material sources and diversified product offerings also will add to the company's success. The capacity shutdown by its key competitor Coppers is also likely to strengthen Rain Industries' position. Now, the second company in the list is Graphite India Limited, which is available at Rs 664.90. Now, Graphite India Limited is engaged in the manufacturing of graphite electrodes, graphite equipments, steel, glass reinforced plastic, which is GRP pipes and tanks, and also the generation of hydel power. The company operates through 3 segments: graphite and carbon, steel and others. Now, this also has been a huge wealth creator over the last 1 year and has judiciously gone ahead and reduced its debt from 0.8 times his equity in 2008 to 0.1 times its current equity. The company will benefit from any sort of anti-dumping measures which have been implemented, and also the brokerage, which is Ambit Capital, expects its multiples to grow to 26 times its earnings per share by the year 2019. Now, one important factor about this company is even during the slowdown years, this company did not report any losses. Now, which is a very positive sign. Market cap of the company is 12,990.52 crores, which means that it's a mid-cap one. The EPS is 10.48, which means that the company is available at a very expensive price to earnings ratio of 63.44. Now, even though this is expensive, this is cheaper compared to the industry PE of 98.26. The book value is 94.78, which means that the company is available at a price to book ratio of 7.02. The promoter holding here is decent at 65.09. Now, the third company on the list is GRNLAMIND Industries Limited, which is available at 1171 currently. GRNLAMIND Industries Limited is a laminates manufacturing company and is engaged in the business of manufacturing laminates, decorative veneers and allied products through its factories at various locations and branches and dealer networks spread all over the country. Now, if you were to see the chart, this also is an uptrending chart for the last 1 year. Now, the reason why Ambit Capital thinks that it could be a wonderful buy going forward would be because the company's export revenue has jumped to 44% of its total revenue in 2017. Now, this was 15% about 9 years ago. Now, it also has a very accurate brand positioning, distribution network and region-specific product portfolio, which will basically drive GRNLAMIND's success in international markets. Also, the engineered wood floorings business is also expected to become profitable in the next 2 years and would add to the bottom line. The focus on margin improvement also should drive the multiples in future to 26 times its earnings per share. Now, if you were to look at The EPS for the company, it's at 21.52, which means that the company is available at a price to earnings ratio of 54.34, which is expensive compared to its industry PE of 50.32. The promoter holding is on the average side at 54.74. The book value is 125.57, which means that the company is available at a price to book ratio of 9.31. Now the fourth company on the list is KRBL Limited, which is available at 613.55. Now KRBL Limited is an India-based basmati rice processing company. The company is engaged in seed development, contract farming, procurement of paddy, storage, processing, packaging, branding and marketing of basmati rice. Now if you were to look at the 1-year chart for the company, you would see that it's a consistently uptrending one. The market cap of the company is 14,442.35 crores, which means it's a mid-cap one. The EPS is 19.69, which means that the company is available at a price to earnings ratio of 31.16, which is a little less expensive compared to the industry PE of 36.99. The book value is 79.51, which means that the company is available at a price to book ratio of 7.72. The promoter holding here is average at 58.81. Now the reason why Ambit thinks that it could be a potential multi-bagger going forward is because it has gone ahead and adopted things like the PUSA 1121 seeds, which are higher yielding and have shorter maturity time, helping establish its base. Also, KRBL has maintained strong farmer relationships through the end-to-end management of grains, and it has years of experience and aggressive advertising, which has led to the creation of a very successful brand. Additionally, the company is also developing long-term relationship with distributors in the key Middle Eastern markets, which could be a potential differentiator going forward. Now, the fifth company on the list is Lakshmi Machine Works Limited, which is available at 5834.35. Now, Lakshmi Machine Works Limited is an India-based holding company engaged in the manufacturing and selling of textile spinning machinery, computer numerical control machine tools, heavy castings, and ports and components for aerospace industry. Now, if you were to see the chart, it was on an uptrend for the initial part of the year, but largely has been range-bound since then. The market cap of the company is 6391.82 crores, which means it's a mid-cap one. The EPS is 194.78, which means that the company is available at a price to earnings ratio of 29.95. This is lower compared to the industry PE of 35.25. The book value is 1404.25, which means that the company is available at a price to book ratio of 4.15. The promoter holding here is on the lower side at 30.07. Now, an important component about the company and the reasons why Ambit thinks that this could be a multi-bagger going forward is that Indian government measures like the reduction in the goods and services tax rates and the implementation of programs like the integrated skill development scheme will hugely boost sales and also encourage capital expenditure. Also, this company is investing in research and development, client management and cost effectiveness, which will make it a potential market leader. Also, it has debt-free balance sheet and also posted a compounded annual growth rate of 42% in the last 6 years till 2016. Also, the company is well placed to gain market share but faces imminent risk from the cyclicality in the industry, which is a risk highlighted by Ambit. Now, the brokerage here expects multiples to grow to 25 times earnings per share in the year 2019. Now, the sixth company on the list is SYMPHONY Limited and its subsidiaries, and this company itself are engaged in manufacturing and trading of residential, commercial and industrial air coolers both in the domestic and international markets. The company operates through two segments, air coolers and corporate funds. Now, if you were to look at the 1-year chart, you would see that the stock has largely not done much, and even though it was on an initial uptrend for the first quarter or two, but then since has been a period of consolidation and not much movement. The market cap is 11,586.98 crores, which means it's a mid-cap one. The EPS is 25.37, which means that the company is trading at a very expensive price to earnings ratio of 65.29, which is also expensive compared to the industry PE of 59.97. The book value is 65.46, which means that the company is available at a price to book ratio of 25.30. The promoter holding here is very good at 675. Now, the reason why Ambit thinks that it could be a potential beneficiary going forward is because SYMPHONY can become a much larger brand with its recent successful acquisitions and strong balance sheet, and also it has a policy to reward shareholders by maintaining a healthy dividend payout ratio, and cost conscious operations has led to greater confidence among the various stakeholders. Also, the single product debt-free company which SYMPHONY is in a comfortable position with nearly 50% share of the organized air conditioner market in India. The brokerage here expects the multiples to grow to 40 times earnings per share in the year 2019, which is expensive but manageable for a company which is growing at such a vast rate. Now, the seventh company on the list is VINATIORGA Limited, which is engaged in the manufacture of organic and inorganic chemical compounds, nitrogenous energetic compounds, which is basically NEC. Now, this company is available at 1039.50 and is also a company which has created a lot of wealth over the last few years. The market cap of the company is 5362.89 crores, which means it's a mid-cap one. The EPS is 25.86, which means that the company is available at a price to earnings ratio of 40.20, which is on the expensive side, but is largely in line with its industry PE. The book value is 131.82, which means that the company is available at a price to book ratio of 7.89. The promoter holding here is good at 73.97. The face value is 2 and the dividend yield is not very good at 0.05. Now, the reason for Ambit going ahead and choosing this as one of their companies to watch out for is being the sole manufacturer of vinyl polymer acrylamide tertiary butyl sulfonic acid. It gives a competitive edge because there's no other company which basically does that in India. The expansion into paracetamol, intermediate and IB derivatives will also assist the business growth. VINATIORGA's earnings may triple over the next 5 years with its approach of scanning for disruptive processes straight out of academic research. Now, Ambit expects Vinati's multiples to increase to 27 times its earnings in the year 2019. Now, the final company on the list is ESSELPACK Limited, which is a producer of plastic packaging materials in the form of multi-layer collapsible tubes and laminates, used primarily for packaging of toothpaste, personal care, cosmetics, pharmaceuticals, household and industrial products. Now, if you were to see the chart for it, it's not been a wealth created and it's largely been range bound for the year. The market cap of the company is 4405.04 crores, which means it's a mid-cap one. The EPS is 4.21, which means that the company is available at a very expensive price to earnings ratio of 66.54, which is much more expensive compared to the industry PE of 26.05. The book value is 39.56, which means that the company is available at a price to book ratio of 7.08. The promoter holding here is average at 57.17. Now, the reason why Ambit thinks that this could be a very good beneficiary going forward is because it has a greater innovation, wide portfolio offerings and extensive global reach, which have rendered a key competitive advantage. Now, also the operating profit of EPL has improved by 210 basis points between the year 2012 and 17 due to value-added product launches in laminated and plastic tubes, business growth and greater capital allocation. Now, also EPL is fast expanding into the non-oral care business with close to 42% market share in the year 2017. Now, this is as per Ambit's calculations. Now, the brokerage expects a pickup in ESSELPACK Limited's growth in the second half of the year as GST related issues would basically abate by then. Now, friends, please don't treat this as a stock recommendation. Go ahead and do your own research. And the disclaimer that we would like to make is that we have VINATIORGA in our own portfolio. So please do your own research, and this is all what we wanted to show you for today. Thanks for watching, and we will see you soon with another video.